In this presentation, we will use tax software to run scenarios related to the deductibility of student loan interest. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Remember that student loan interest represents us having taken out a loan. A student would have taken out a loan, paid for schooling, and now we're at the point of paying back the loan. So we're imagining we're working now, we're paying back the loan. As we do so, we'll pay both interest and principal on the loan. And typically the institution will give us something like this, which will show us the student loan interest. This will be the amount that we would start with, that we would then enter into our tax system to see if we get any benefit from it from a tax perspective. Here we are on our test 1040. We have our single individual, no dependents for our first example. If we go to then page 2, we're going to say that there's 40,000 of wages. That's where we will start out. We can see that the 40,000 is total income and there are no current adjustments because the adjusted gross income is the same as the total income. Standard deduction, 12,000. Giving us the taxable income, the 40 minus the 12 of the 28,000, and tax calculated by the system of 3,173. Now we'll add student loan interest. As we do so, we're going to see a difference between these two numbers if it's something that will be applicable. Those items will be found on Schedule 1. So we're going to say, okay, we have to add something to Schedule 1. If we scroll down through Schedule 1, we see the adjustments to income. Adjustments to income, we're down here on line 33, looking for student loan interest deduction. So here's student loan interest. I'm going to right-click on it and jump to the input screen in this software. Input screens will differ depending on the software we have. We will now enter the interest amount. Remember, this isn't the entire payment we made on the student loans, because we probably paid a lot more, but this is the interest portion given to us on a Form 1098 from the institution, 1099-8E. 1098-E. So here's the 2,000 we're going to say that was reported on that form. If we go back to our forms then, we're going to say what happens. There's the 2,000 in student loan deduction. And if we go back to page 2, 1040, page 2, we then see a difference between the 40,000 taxable income from the wages and the 38,000. That difference, of course, being the adjustment we just put in place. We are now back to our original scenario where we had the 40,000 and no adjustment there, no interest adjustment. And so the 40,000 for the adjusted gross income is the same. If we now go to our Schedule 1, and we go down to the adjustments and we do the same thing, we're going to go to the student loan. So I'm going to go to the student loan interest. And now let's just see if we up the amount to like 3,000. See what that does. So go back to our forms and we're going to say the amount is, and it capped it. You'll see it capped it at the 2005. That's the cap. That's not a phase out. That's not because of our AGI limitation. That's the amount, that's the maximum amount of the student loan interest that we can deduct. Now we have a new scenario, and all we've done is upped the income. So now we're saying that this individual earns 100,000. 100,000 of wages, 100,000 total income, and the adjusted gross income is the 100,000 as well. Let's go ahead and add our interest. So we're going to go back to the Schedule 1, to the adjustments, and we'll go to the student loan interest. See, okay, student loan interest, what happens? If I go back to that 2,000, I know I only get 2,500. That's going to be the cap, so we'll put the 2,000 there. Go back to the forms and see what happens. Nothing happens. Why didn't anything happen? Because we're at an income phase out. The 100,000 is too high. We could see that calculation here. We won't go through the entire calculation, but you can take a look at this. In essence, the income is too high, we're over that top threshold, and therefore none of it is going to be deducted. So if we go back to our 1040, then of course there's no difference between the taxable income and the adjusted gross income for that amount. So now we'll make a change and say, okay, well, what if we're in the middle? What if we change our income to, let's say, 70,000? So we'll go and change our income to, say, 70,000. And we'll go back to our return and say, okay, something's happening there. The 70 compared to the 68,666. If we go back to Schedule 1, see what is happening. We had 2,000 that we input and we're only getting part of it. So now we're in the phase out somewhere. So now we're in the phase out. Here's the calculation. We won't go through the full calculation for it, but you can see what that calculation is. So you want to get just a sense of when this would be beneficial. What's the lower limit? What's the upper limit? Basically, it's going to phase out, and then you can get more into detail about what those phase out rules if necessary. For more accounting information and accounting courses, visit our website at accountinginstruction.info.